If you were invested into the financial markets, the last thing that you want is the Powell pivot. Yes, sounds a little bit counterintuitive, but with inflation cooling down to 4.9% today in America, this is leading many investors to rejoice, announcing that this is the end of the fastest interest rate hiking schedule in history. Most people assume that Powell's job is over and we're about to get the infamous Powell pivot, which most people expect will pump the financial markets. But what we can see from this chart right here is that every single time Jerome Powell or any central bank has pivoted their interest rate policies, the financial markets have actually crashed. We can see in 1969, we saw a Fed pivot and the markets crashed by 36%. In 1973, the Fed pivoted and guess what? Markets crashed by 48%. In 1981, it happened again. The Fed pivoted and markets crashed by 27% in the following year. I know a lot of you guys might be a little bit confused right now. We're going to explain why this phenomena continues to happen at the end of today's video, but I want to first look at the second chart I want to show you guys to analyze the more recent Fed pivots in a little bit more detail. So I've found this really cool little website. You can see here in the red bars, that is interest rates, and in the blue, that is the S&P 500. And I want to zoom in here to the last 10 years of data, okay, to kind of analyze what has happened in the markets. And having a look here in 2007, we can see the federal funds rate was dropped from 5.2% to 4.9%. And guess what that meant? That was the beginning of the Fed pivot, and equity markets absolutely crashed between 2007 and 2008, defying all perceived logic, okay? Most people believe that the Fed pivot is going to pump markets, but this is not the case. Interest rates were even smashed all the way to zero in 2007, and this began the ZIRP era. That is the zero interest rate policy era, and this was a new era of central banking. And we can see that after phase 2 of the Fed pivot, that equity markets finally put in a bottom in 2008 and actually rallied. We're going to explain what phase 2 is at the end of the video, but I want to look at the last Fed pivot. That was in 2019. We can see here that rates were dropped from around 2.4% to 0% between mid-2019 and early 2020. And we all remember in 2020, we saw the fastest stock market crash in history. The S&P 500 crashed by 35% in only 3 weeks, which was an even faster crash than what we saw in the 1929 Great Depression stock market crash. Why did markets bottom in March of 2020? What brought relief to the equity market pain? Of course, that is phase 2 of the Fed pivot, which of course is money printing. The central banks have 2 tools to control liquidity in the markets. The first being interest rates, the second being adding liquidity or withdrawing liquidity into and out of the system. So every single time that the Fed believes we're about to enter a recession or a slowdown, what they will do is they will begin cutting interest rates to try to stimulate people to go out there and borrow more debt because those interest rates are lower. And when that doesn't work and when the markets continue to crash, the Fed falls back to its second monetary policy tool, the more sharper tool, in my opinion, and that is just injecting capital straight into the markets. And we can see here that whenever the Fed begins to inject liquidity into the markets, markets typically rally and they are typically pumped up, okay? So most people will say, when should I buy, Luke? Should I wait for stage 1 or stage 2 of the Fed pivot? In this video, we've shown with historical data that the best time to buy is actually when the Fed begins to inject liquidity into the market, okay? That is stage 2 of the Fed pivot. You should not be buying anything when the Fed begins stage 1 of its pivot, which is actually cutting interest rates, okay? Typically, stocks crash after then, but they find a bottom after the Fed begins to print new money and put that into the system. But things could be a little bit different this time because right now, the Fed is pumping liquidity into the system while at the same time still raising interest rates, okay? We can see here, this is the chart of the Fed's balance sheet, and it's zoomed in on the past few years here, and we can see the Fed was successfully able to actually shrink its balance sheet by around $800 billion but we can see what happened in early 2023. We had that banking crisis, okay? Silvergate, Silicon Valley Bank, and then Credit Suisse in Europe. All of these banks began to go bankrupt because they need liquidity continually pumped into the market, and they need interest rates low, not high, okay? Central banks around the world have been raising interest rates aggressively over the past 18 months, and we can see just how much liquidity was pumped back into the system in only the space of a month previously, okay? As this banking crisis happened, the Fed created a new tool. That is, of course, BTFP. A lot of people call that by the effing Ponzi. That's what Greg Foss called it in our interview last week. I recommend you go and check that one out. I believe BTFP is actually called Bank Term Funding Program, and it's not QE, okay? Yes, it is pumping liquidity back into the system, but our central planners and authoritarians have been very clear about the fact this is not QE, but we can see how much liquidity was pumped back into the system. Around $500 billion was thrown back into the system in only a month's time, almost reversing a whole year's worth of quantitative tightening, just showing just how quickly a pivot could come and just how quickly the Fed can undo all of its great work with, trying to normalize its enormous balance sheet. Now, I want to put this recent quantitative tightening in a little bit more context, because this will help to kind of give us some very clear conclusions and takeaways at the end of this video. We can see here over the past 12 months, central banks around the world have been aggressively fighting inflation. And just look at how big this dip is in the Fed's balance sheet, okay? They were able to shrink their balance sheet an enormous 7%. And obviously that led to an enormous banking crisis in early 23. It was actually the biggest bank run since the 1920s Great Depression. I wanted to show you that chart because it really does put everything into much better context, okay? The Fed and the central bankers cannot normalize their balance sheets, okay? They are far too indebted and the world cannot sustain these very high interest rates. So how do you guys make money in an increasingly volatile world? This chart here shows that the volatility in the markets is only increasing and increasing over the past 2 decades. So how do you guys profit from it? If you're enjoying this video so far, you're probably going to love the Substack article that I wrote on this very topic. Again, there's only so many charts, graphs, and statistics that I can cram into one 10-minute video. So I cover this topic in more depth in that article. So let's get back into this one. And most people will say, just dollar cost average, bro. You know, time in the market is always going to beat time in the market. And I believe that is wrong. Yes, you heard me correctly. I think both of those sayings are absolutely useless. And that is because if you spent time in the market over the past 20 years, you have lost money. And now I bet most people are really scratching their heads, because when we look at stocks priced in dollars, we can see that they are some of the best performing assets in the past 10 years. The S&P 500 is up by over 500%. The NASDAQ is up by over 700% in the last 10 years alone. And people are thinking, you're an idiot, Luke. You don't know what you're talking about. But what they're forgetting to do is to actually denominate those stocks by the money supply, okay? We've all been given the illusion that prices of everything continues to go up, when in fact, what we're actually watching is just the debasement of our currency, okay? The central banks around the world have printed tens of trillions of dollars in the past 10 years, and they've pumped all of that liquidity into the asset markets. And when you actually measure these asset markets by the Fed's balance sheet, we can see a very different story. So this here, I've taken the S&P 500 and I've divided it by the Fed's balance sheet, okay? What we can see here is when we divide the S&P 500 by the Fed's balance sheet, the S&P is actually down by over 70% since 2008. And yes, they are the 500 best companies in the world, but most people might be thinking, what about the NASDAQ? The NASDAQ's performed even better, and I've made heaps of money off the NASDAQ. Well, similar story, my friends. We can see here that the NASDAQ is actually down by over 40% since 2008. And some people might still be scratching their heads at this stage of the video, and they might say, oh, but what about my Dow Jones is the 30 most successful companies in the United States? They're the blue chip companies of America, the most successful country in the world, but similar story. Dow Jones is down by over 75% since 2008. And the only asset that has actually outperformed the Fed's balance sheet over the past 15 years, as the Fed's balance sheet has grown from zero to around $9 trillion, is, guess what? It's Bitcoin. We can see here that Bitcoin is up by over 14,000% since 2015 alone. When you denominate Bitcoin in the Fed's balance sheet, that is a 140x in price since 2015. Unbelievable gains. So I think the real advice we should be telling people is not DCA into the stock market. It's actually DCA into Bitcoin, because I want to highlight a really cool tweet here from Dylan Leclerc. And he actually shows that if you began dollar cost averaging into Bitcoin at the $69,000 top in 2021, you are actually in the green today in early 2023. That is correct. Most people be really scratching their heads now thinking, hang on a minute, Bitcoin is still down by over 50% from its all-time high. If I started buying at the very top, how could I be in the positive today? And that all comes back to something called dollar cost averaging. So in this analysis that Dylan ran, what he did was he pretended to buy $10 of Bitcoin every single day since the 69,000 all-time high peak. And it shows that the average cost basis for that person who would hypothetically do that would be around $25,700 today, which means, guess what? You are in the green. If you bought Bitcoin every single day since the 2021 all-time high at 69,000, you are in the green today. And this just shows why Bitcoin is such a great asset to own, and something that everybody should own at least a little piece of, because it actually decreases the sharp value of anyone's portfolio. It is a decorrelated asset. Most people be scratching their heads when I say that, but just remember, the S&P 500 is only up by 4% this year. Meanwhile, Bitcoin is up by over 90%, okay? The decoupling has already happened. Bitcoin is an anti-fragile asset. Even during the worst time frame you could possibly pick for Bitcoin, which is the past 18 months, you were still in the green if you were dollar cost averaging into Bitcoin. So that should be a great takeaway for today's video. You should dollar cost average into your savings account, okay? Bitcoin is your savings account. Yes, it is volatile when you price it in the USD or any other fiat currency around the world. But when you zoom out just a little bit, Bitcoin is the best performing asset in history. It's the best performing asset since 2020, and it's the best performing asset since 2023. And before we round this thing out, I want to quickly thank today's show sponsors. If you're a high net worth individual looking to buy more than $10,000 of Bitcoin, I would love to point you towards my newest YouTube show sponsor, who of course is Bitcoin Reserve. They're a great Bitcoin only company, and they're going to help you buy Bitcoin with the lowest fees, fastest settlement, and do it all in a privacy preserving way. BitBox02 Hardware Wallet, the easiest hardware wallet there is in the space. Amber, guys, they're giving you $10 of free Bitcoin if you sign up using the Amber exchange. Super easy to use. We just roll it out to 62 countries. So with all that said, hope you guys have a good day, and I'll see you all in the next video.